So, as I mentioned in my last video, the Move Now program is designed to be a short term loan up to 4 months as a bridge loan between selling and buying your new home. In this video, I'm going to review some key information and qualifications that a borrower needs to be aware of in order to qualify for this program. Not everybody is going to qualify, and so it's very important to pay attention to these. And of course, if somebody's interested, I will walk them through this and make sure that it's a good fit. So, first of all, this program is designed for someone that owns a home currently and wants to buy a new primary residence and sell their current home after closing. That's kind of like a buy now, sell later type option. There are two separate loans when using this program. There's the first loan that is a short term loan that's about 4 months, and a second loan that would be the permanent loan for the refinance of the short term loan. The borrower that uses this program has to have a 680 credit score, and this is the only option for primary residence. What is awesome about the max loan on this one is that the short-term loan is 100% financing, like 100% loan to value. What that means is we can finance the entire amount on the short-term loan. So if you're buying a $200,000 house, we will finance $200,000 on the short-term loan only. When we get to the long-term or permanent loan, we will do a loan to value at 95%, which basically means a 5% down payment. So again, we will finance the full purchase amount on the new home. And when your buyer or you get the proceeds from the sale of your previous or departing residence, you would need to put 5% of the proceeds down as your down payment on that permanent loan. Some key notes on this program is that the departing residents must have at least 20% equity currently, and we will check to make sure that there's enough equity to pay for realtor costs, selling costs, closing costs, all that sort of stuff, and still have the 5% minimum down for the permanent loan once that home sells. This is really important because it protects the buyer so that they can finalize the loan on the new home down the road, and it keeps them from potentially going in default by not having enough money to cover each of the different costs. So the short-term loan is an interest-only loan for 4 months with an option to extend another 60 days if needed, but that does have an additional cost and fee. We do not want to do the 60-day extension if any way possible. Again, this is a short-term loan. And so it would need to be paid off. That short-term loan would need to be paid off with the permanent financing within the first 4 months or within 30 days of the departing resident's closing, whichever occurs first. The max debt to income ratio on the permanent loan would be up to 45%. And we do this so to give a little bit of wiggle room in the event that rates change, or maybe the buyer does not get as much in proceeds, all that sort of stuff. We're giving us a little bit of wiggle room because technically a conventional loan, you can get an approval up to 50%. But for this, when we're qualifying somebody, we are going to do it up to 45 just to be on the safe side. Again, we're kind of making sure that we're protecting you as the buyer or your buyer to make sure they can finalize that permanent loan once the other home is sold. When we're qualifying somebody for that permanent financing, we do not count the previous home and like the principal, interest, taxes, and insurance in the debt to income ratio to qualify. And that is because we are assuming that the previous home loan is going to be sold prior to doing that permanent loan. And that's what the bridge loan is for. That's the point of doing it. We do require that the borrower has 4 months of principal, interest, taxes, and interest in reserve, so liquid funds. We're basically making sure that they, again, are protected because keep in mind, they might be paying for a mortgage on the departing residence and the short-term interest-only loan at the same time. So we want to make sure that they have the money to be able to cover the cost for both of those. And this also protects them, just so, again, they're not going to go in default on either of those two loans. And we want to make sure they have that money. The type of property that's eligible for the short-term loan is a one-unit single-family residence or a home that's in a PUD. Properties that do not qualify, that's good to know, right? What doesn't qualify is a condo, a 2 to 4 unit home, a manufactured home, Homes over 20 acres are rural properties. Those just do not qualify for this program. We had to put some guidelines out there and what we would be willing to take on the short-term loan, and that is how we do that. So the departing residence may not exceed 10 acres, and it may not be located in a retirement community or where there is new construction with production builders in place. We do that because it is hard to sell a pre-owned property when you're competing against new home builders nearby. They're offering crazy incentives, and it is just hard to be competitive to sell the house. And again, this is a short-term loan, so we want to make sure that the home you're selling can be sold usually within that 4-month period. A good rule of thumb is 100 days. Try to get that home sold in 100 days, and you'll be on target. Let's see. We require the departing residents must have fully operating HVAC, plumbing, and electrical, and no ongoing rehab or renovation going on the property. Basically, the house has to be in good condition so that it will sell within that 4-month period. It must have public road access and be residential zoning. On the departing residents, we do still need to have active homeowners insurance policy in place, and it needs to have an active MLS listing or fully executed listing agreement along with signed letter from the borrower stating the home will be listed on MLS within 3 weeks from the short-term loan closing. Again, this is trying to keep the buyer on target for that 4-month period short-term loan to get that refinanced into the permanent loan, get the home sold within 4 months, get the perm loan completed within that 4-month period too. We also need the property seller's disclosure notice or in-house departing residence property questionnaire. We need both of those, and also a borrower lien disclosure and certification to confirm what liens will be paid off once the home is sold. We are checking for mortgages, solar liens, mechanic liens, anything like that that would cut into the equity that the buyer or seller, in this case, would be taking out of their out of the proceeds from the home. We're also going to collect mortgage statements and other supporting documents for the departing resident. So just know we are going to collect all those things up front. And again, it's just to make sure that everything is in line, meets our guidelines, and meets the criteria to do this short-term bridge loan. In the event that the borrower uses our bridge loan but refinances with another lender, I sure hope you don't do that for a permanent loan, there will be another 1% commitment fee that's added to the short-term loan payoff. We really want to do the short-term and the permanent loan for you. And to be honest, these bridge loans, they do not make the loan officer or the company a penny. So we really prefer to do that permanent loan. And if we don't, we have to cover the costs for doing these loans by adding that extra fee at the payoff. And also, we want to make sure it's worthwhile for the company to provide this service to you guys. So nothing in life is free. And that would be what the case is there. When we're setting up the short-term loan, we will collect 12 months of homeowners insurance policy and flood or wind policies if applicable. That's because the home they are purchasing still needs to be insured during that 4-month period of the bridge loan, because we can never predict when a storm or something hazardous happens. So we have to be protected 100% of the time. Worst case scenario, something does happen to the home, and we just want to make sure that the home could be rebuilt so that we can do that permanent financing at the end of the day. Escrows are not collected on the short-term transaction. So the buyer is responsible to pay any taxes or insurance due at the time of the short-term loan unless they are due at the time of the short-term loan closing. So an example of that would be if they're closing at the end of the year and the taxes would be due, then we would collect those on the short-term loan. Otherwise, the borrower would need to set up an account and put aside the taxes and the insurance because they would be collected at the permanent loan closing to set up the escrow account. But on the short term, we are not setting up an escrow account. Okay. I know this was a lot of information, and I'm happy to talk through this with you as the buyer or seller and or the agent if you're interested in offering this option to your clients. You know, anybody that might utilize this program, they really need to know all the details and the ins and outs. And I'm happy to talk you through it and let you know any details, find out if you qualify, if your property qualifies, all that sort of stuff. I'm going to walk you through everything. So let me help you get closed on your new home by using this new MoveNow Bridge loan. I love that we have so many options to help homeowners meet their goals and without having to make an offer with a contingency offer. A lot of times sellers for the new home, they do not want to take a contingency offer. I have clients all the time that say, well, the seller won't accept a contingency offer, so I have to get my other house under contract and basically almost sold before I can go buy a new home. That usually leaves somebody homeless, or where they're just rushing to get everything completed. They have to be out of their other house and move into the other one, or find a place to live in the interim. So this is where this program comes in really handy, because we can help them do all of the above without feeling all the stress of trying to sell first and then buy. They can sell and buy at the same time. Again, buy now, sell later. That's a really great option. So if you'd like to have a schedule, like a free 30-minute consultation, you can do so by going to my website, schedulewithannie.com. We can go over some options for you. And just in general, if you're looking to purchase or refinance, maybe you don't need a bridge loan, I'd love to help you with that too. You can always apply on my website at www.anniegetyourloan.com. And I would love to help you with any of those options. So keep in mind, Annie McNeil with Pilgrim Mortgage, and loans big or small.